And officially, good evening and welcome out to the Market Watch Group Working Sessions Intermediates. I should take out advanced. It's really just an intermediate. We open the door to whatever at this point. Whether it goes into options, whether it goes into like tonight, we're going to talk a little bit about Kelly criteria and risk optimization. We're going to talk a little bit about meta because that's where I see the most mature flag pattern setting up. So I entered discreetly. I mastered the art of exiting discreetly. I consider myself to be a master of the Irish goodbye. Everyone looks around. They're like, "Where's Scott?" I'm like, I was home an hour ago. What are you talking about?" Oh, okay. I am Scott, by the way. I'll be hosting tonight for the next little bit as we work on some other things. Here's our disclaimers, as always: not brokers, not advisors, no guidance, no advice. This is for education and illustrative purposes only. Whoa! And now we go to the platform where we do work. Hence the term working sessions. Win some. If you missed it, you might have caught just the tail end. We were just doing like a real broad charting overview, whether you're on Thinkorswim or other platforms. Charts are charts. They're all going to have basically the same type of construct in the way that they work as software, right? So I have the ability to add and edit indicators. I can change time frames. I can change chart types. I can draw. I can zoom in and out. Those are the basic functionalities that any chart is going to have. Do I like Meta better than Google? Well, let's go take a look, first of all. We are going to look at the trading logs. So I'm going to have a stock and an option log. Actually, I'm probably just going to look at the option log. Let's get that over here. Why? We're talking about this line here. I can't highlight it. Real quickly, Miguel in Discord chat asked about, he wants to try to integrate this with another spreadsheet he's working on. Great, phenomenal idea. And Steven, who I don't think is in attendance tonight, he may be traveling, offered. But if you ever wanted to, if you come into the spreadsheet and you go to review, it's protected, but it's not locked. There's no password or anything. Here's the deal. If you come in and you unprotect this sheet, you're on your own. That's all it means. If you unprotect this sheet and then you come to me and you're like, "Hey, Scott, I was doing this with the sheet. Now this doesn't work." I'll be like, "Is it protected or unprotected?" And if you're like, "Unprotected," I'll be like, "Oh yeah, no, you're on your own," right? It's like Apple with the iPhones, and they talk about you can quote unquote break it. There are some things you can't do on an iPhone unless you break it. If you break it, it basically just sort of unlocks the ability to put like non-Apple approved apps on your, which, some people may never have the need for that. Now, if you break it, it like affects their willingness to fix certain things. You've sort of said, "Hey, I'm opening this up to the jungle." So you get what you get if that happens. Same thing applies here. If you unprotect this sheet, it allows you to come in here and you can get into these formulas and you can see what they are, which means you could change them, which means you could break them. And if you come in here and you change it and break it, I can't come back in and be like, "Oh, well, now let me look at this for you," because that's just outside the scope, if that makes sense. So if you want it, can you have it? Yes. But once you do that, that's your spreadsheet only. I can only make sure that the spreadsheet works so that it works for everyone. Does that make sense? I hope that makes sense. But other than that, yeah, jump in and have a look, right? Jump in and have a look. So if you want to know what the Kelly criteria formula is, it's not complex. Both expectancy and Kelly are play on your percent winners, percent losers, and your reward to risk ratio. That's literally all that goes into it, but they're just very powerful equations as far as the information that it gives us. There you go. That's it, Miguel. Love it. You break it, you bought it. I love it. Yes, that's all you got to do. And then you can make. So if you're not trying to change anything for any reason, there's no reason for you to go unprotected. What protection does is it means you can only fill out in this spreadsheet. You can only fill out the gray ones. Only these 4. Everything else is calculated for you on an automatic basis. So on this dashboard, all you can do is say, here's how much money I started the quarter with, and here's how much risk I'm willing to take. That's it. On the trade log, you can fill out anything through here, anything in here, this one, and this one. Everything else, you can see I can't click it. It's locked. So it's built to protect people against themselves. Because prior to doing that, I used to have people be like, oh, my spreadsheet's not working. And then I'd go look and I'd be like, well, you changed the formula. You can't do that. So rather than telling people they can't change the formula, I literally just took away their ability to do so. And it worked out much better. But for this group, I want you to have the autonomy to go in there. But with that freedom comes consequence. And it means that you're on your own with whatever you do with it next. Okay. Now let's talk about the dashboard. Let's talk about Kelly. Kelly is risk optimization. Kelly is the formula that we use to try and make sure that the risk levels we're taking are commensurate with the capacity for risk that our system has. If you have a negative Kelly, that means that you have not established a profitable trading system yet. Negative Kelly derives from negative expectancy. Negative expectancy is what? A casino. The longer you stay, the more you'll lose. Can we get a positive expectancy in a casino? Yeah, remember I told you the story of the guy who did that? It's called Beat the Dealer. Single deck, count the cards, find an edge, make money. Get very impolitely told never to come back to the state of Nevada. I don't think they would do it that way anymore. They just kick you out and tell you can't come back. They ban it. So, that's one thing to consider. What else? Yeah. So, you know what? Let me grab just so I can show this, and then I'm going to go look at the trade. We're going to answer the question Google or Meta, and we're going to start to explore that because there's a very good chance it becomes the next trade alert. So let's open up our sample trading log. Sample trade log. What does it look like when it's filled in? So this is a blank one here. It's so plain. Where is it? It's so plain and empty, right? End of formulas. Don't go past this black line. And the dashboard is just so empty. This is what it looks like when we fill it in, and it becomes useful to us. Maybe. There it is. This color coding is manual, though you can code it to be automatic. I prefer it manual. When I have winners above 1.5, or when I have a big winner or a big loser is red. Close to a big loser is yellow. Those are how I like to code these. I haven't done it all the way through. I just was showing it on one quarter, right? So on one quarter, I could go in and say, oh, let me figure some additional things out. Why do I have so many red days is a question I might ask myself. You can only color code it if it's unlocked, though. I'll tell you that. Unfortunately. Okay. So this is filled out. Let's go to the dashboard. What do I know? So I would come here, and you can see that it fluctuates. First quarter expectancy was 22%. Kelly was 12%. Very good, right? This is starting with $50,000. I made almost $6,000. That's 11% in the quarter. It's a pretty good quarter. I think we would all agree. I think we would all be fine with that quarter, right? 25 trades, nice quarter. Then the next quarter, what was my Kelly? Oh, it was only 0.2. I was basically a break even. I ended up making $22. That's not great. Then what? Then the next quarter. Now, I say quarter because I did this over the entire year. It may not be that way. It might be every month. It might be every 2 months. But for mine, it's every quarter. The next time I got 25 trades, you can see, look at this one. This was fantastic. 9,200. My expectancy was 45%. That would let me take a lot more risk. I made $9,000 on that quarter, and then the last quarter was decent. I made $2,900, 8% expectancy. Well, those are 4 very different quarters. What do I want to do with that? I want to take the aggregate. Now I have 100 trades profitably. My aggregate expectancy 19%, or expectancy is 19%. Is that good? Well, let's think about this. If this was 1 year and I started with a $50,000 account, at the end of this year I made $17,965. That is about 36% for an annual return. 36%. Ask Warren Buffett what 20 to 25% gets you over time. That's 36%. 25 trades a quarter? That's only 8. That's only 8 trades a month. That's 2 trades a week on average. Is that a lot? Is that like I'm such an active trader, I trade all the time? Not at all. That's a manageable set of numbers here. Is 20% this outrageous expectancy? I know Stevens produced better than that. I know others have as well, but is 20% such this great? No, it is great because it's profitable. What I want you to notice is that this is all attainable, right? This is not like, oh man, how am I ever going to achieve a 37% annual return? This is how. This is one path. There's a lot of different paths, but you can see here, my expectancy, and so at the end of it all, 19% expectancy, 15% Kelly, profitable. Now what? Now going forward, I want to optimize my risk. So what am I going to do? I'm going to take that 15%, and the first thing I'm going to do is I'm going to multiply it by 0.7. 0.7. Okay? Why? Because I'm going to draw this for you real quickly. You would think it's like a bell curve that ends up flattening, but it doesn't. This is risk with 15 right here. So theoretically, 15 is at 100% of Kelly. What would 70% be then? Would be about 10.5. So if I go here, that's 10.5. This is 20. If I take 10.5% risk, I'm going to make about the same as if I took 20% risk. But I have a little bit of error that if I took a couple of extra trades, there's a cushion for that, where over here there's not a cushion for that. the amount of risk I take is important. And I reference it around Kelly because that's the peak. That's the pinnacle. Kelly is where I will make more money than any other system over time. That's it. That's what piqued my interest. I'm like, wait, what? This will produce better returns than any other system over time, unequivocally. The book written about this formula is called Fortune's Formula. It's magic. So we're going to use it. So the first thing I do is I say, now here's why I do this. Because if I take 70% of Kelly, I achieve 90% of the gains. So from here to here, you don't get much more. 70% of Kelly gets 90% of gains. 50% of Kelly gets 70% of gains. So I want to be somewhere between 7.5 and 10% risk, because that's going to achieve, from a reward to risk standpoint, the best returns. I'm more aggressive, so I'm going to 70%. So based off of this, 10.5 is that's my risk that I'm looking for. What am I going to do with this? I'm going to divide that by the number of trades I tend to be in at any given time. So if I tend to be in 5 or 6 trades at any given time, I'm going to divide that by 5, and I'm going to say my risk per trade is 2%. If I'm in 7 or 8 trades at any given time, I'll divide it by 7 or 8, and it'll tell me 1.5% risk per trade. If I'm in up to 10 trades at any given time, I'll divide it by 10, it'll say 1% risk per trade. So when your coach, or when you hear someone say your position size should be 1 to 2, maybe 1 to 3% risk per trade, that's not arbitrary, but they probably didn't go through the detailed process to be able to explain exactly why I want 1 to 2%. This is exactly why I want 1 to 2%. Now, if I end up getting, if my Kelly goes from 15 to 25, then all of these numbers are also going to improve as well. As you get better as a trader, you will organically take more risk. That's what this method of risk management does for you as a trader. This is absolutely and unequivocally high-level risk management. That's why, I get the hiccups. That's why we're doing it in the intermediate session. This is what we're working towards mathematically for our risk management plan. This is very deliberate, very specific. I know it's probably a lot. I'm going to pause here because I can't see questions. Hold on a second. Let me go see what you guys are talking about. Missed the Kelly criteria. It's risk. So Kelly is going to, let me change colors. Kelly, what does Kelly solve for? Kelly solves for this. Everybody has a risk management curve that would, if you ran it over time, if you ran it over the last 100 trades, it would tell you what risk level would have produced the highest gains. Now, we do that over 100 trades because we're basically saying that we're working off the assumption that what we've done for the last 100 is what we're going to do going forward. If you optimize your risk and then all of a sudden your trading falls apart and you start to trade poorly, you're going to lose money because you're taking more risk than you should now. If your trading falls apart, you should start taking less risk for sure. Over my head, newbie, I'll get there eventually. Yes. This is the long way around to how much risk should we take? The short way is this. If you're a newbie, start at 1% per trade, 5 trades. That's it. That means you'll never be more than 5% portfolio heat, right? 5% portfolio heat spread across 5 trades is 1% risk per trade. What we're doing here is we're saying, hey, you know what? After 100 trades, this is telling me that I don't need to take 5% portfolio heat anymore. Now I can take 10. Theoretically, you could take 15, but I like to give myself a little cushion so that if I have if I have 5 trades on, then I take an extra trade or 2, I'm actually still within acceptable parameters. Like I said, this is deliberate. This is built specifically to provide cushions, to provide parameters. Just found good explanation with all the math on Investopedia. Yeah, Kelly Criterion has certainly expanded its prevalence. I'd like to think that I've contributed to that because it's something I've taught pervasively for the last 15 years. And I've had a pretty good mark on number of students in various platforms during that time. So it is good. That's what we're doing. So that's Kelly criteria right there. That's what it is how do we solve for how much risk can my system sustain? What's the capacity of risk for my system? The only way to figure that is this formula here. Yeah, amazing stuff. Very cool stuff. Very cool stuff. So even though it's for those of you who have stuck around and are drinking from the fire hose, yeah, it's accounted for. The system that we're doing as a beginner accounts for this and allows for us to then transition to this more sophisticated mechanism and process without any pressure to do so. It's not like, oh man, I need to hurry and run, Kelly. It's hurting me not to. It's not. It's not. It's protecting you. And then eventually you'll move into that place where you say, I want to start to really expand my risk understanding. If you have a business with a restaurant, you can only serve so many people in any number of hours or in a day, right? In order to make more money, what do you have to do? Open another restaurant and then open another restaurant. With trading, we have no cap. We could just, it's like, yeah, can I serve 100 people? Yeah. 1,000? Yeah. 10,000? Why not? We just expand. It scales. Right? That's the beauty of trading as a business, is its ability to scale as we improve our risk, our rewards organically grow and expand. It's a very cool aspect of what we do. Any questions about Kelly? The Kelly curve, portfolio heat, trade risk, before I go look at a few charts, because it's a working session. We can't have a working session without looking at charts, man. Okay. Not yet, but soon, Clint said. Good. All right. Let's pop over. Oh, good. I just had a little panicky moment where I'm like, did I forget to start the recording? Nope, I did. I started it. All right. Let's go talk Google versus Meta versus MetLife. MetLife is an insurer. They just got beat up on earnings. We're not going to really pay attention to them. Meta, however, is a communication services giant. We do want to talk about them. They do seem to be flagging. Now, let's go look at Google as an alternative comparison. Here is Google. So, I actually already identified, I want to draw this, Google as an opportunity. I didn't end up putting it as an alert. I thought about it. If you remember, we kind of said we thought this might be one of those little sneaky reversals right here. And that would be our entry. I mean, it's worked. It's gone up for 2 days. I don't feel like, oh, we missed up. I do think that this has some bullishness to it. It may run a little further still before it then pulls back down and gives us another new signal. But that's where I see Google right now. Is it still has potential to rise. It may not. It might start to drop because the market's dropping now. Versus Meta. Let's go look at Meta. Meta bottomed out, had a, we're not calling it a V because it, I mean, I guess you could kind of call it a little bit of a W, right? A big, long, wide W. You can call it a lot of different things. It can be a little ambiguous going through a pattern like this. You can say triple bottom, 1, 2, 3, and that was completed when it took out this level here. You can say a cup and handle, and this is the handle. You could isolate just this and say that this is a bull flag. That all sits on top of each other. All of it can be happening simultaneously and be valid and accurate. So for me, I like Meta better. It's already consolidating. I think it's leading. I think that Google might go up another day or two. If this starts to turn up, I think this thing's going to go. So I'm looking at this for an entry. Maybe it drops another day or two. Maybe it starts to turn. All I need to see is this. Bam. And I think broke the flag, stop loss underneath here. And I'm going to be pretty aggressive. I might not look for the full flag, but I'm going to look for a pretty good chunk of it. I'd probably say from here to here. That's what I'm going to look for as my projection. That's the trade that I see setting up outside of this. Questions, comments, or concerns about what I just demonstrated here? Got a couple people typing. I'm going to let those come through. I don't think there's much setting up right now. We've got a few minutes. Let's just... so seeing possible... I actually see more Meta, less Google. Google gave a signal 2 days ago. It's already moved 2 days. It could go a little more. It could pull back. That one I don't really see as setting up yet. If it's moving up tomorrow, would I get in? I think I would pull the trigger on this with a confirmed entry tomorrow, yeah. And it may turn into an alert as well, Clint. Candle I'm looking for, I don't need it to break resistance. I just need it to turn within the construct of the handle itself. Let me delete this. Let me zoom in a click or two. Whoop, that's too many clicks. I don't need it to break up here at 540. I just need it to break here at 531.09. Take out this high, which means it's taking out this downward slant. That is what I'm looking for. All right, we've got a few minutes left. Let's go peruse our watch list to see if there's anything else. But I have a feeling we're going to just kind of see the same pattern we saw, waiting for a pullback. That's 4 days now that we've meandered higher. But if you had put a trade on, whatever you gained in the meander, you would have lost in the time decay, right? Maybe you gained a couple of bucks if you bought the stock, but is that what you're looking for? No. Looking for a pullback, looking for a pullback. Maybe the pullback has started, but looking for it, and it looks like it has started. So Bank of America. The ones that are leading in these consolidations, I'm looking for the first ones to turn. BLDR, I'm a little iffy on that. Citi, looking for the pullback. Caterpillar, pullback. CL, I'm not feeling the defensives now. CMG, maybe if it stabilizes, that's something you might think about. Costco, did it pull back for 1 day and it's now turned? That could be a maybe. Carvana pulling back. Fastenal. I would trade this as a hiccup if it gives a if it just pulls back for a couple of days without breaking the 200. Bitcoin is kind of stable here. GLD, gold is at a new high, but looks like it's maybe starting to pull back from those highs. General Motors, new high. No, that's false. Not a new high. Not relative to this back here, but it's done enough. What am I waiting for? Pullback. Home Depot. It's just kind of pushing out of the earnings, pushing resistance. Small caps are pulling back a little bit. JP Morgan. A lot of things are starting these pullbacks or are sitting at resistance. So for me, it's like, what are you trading for? It feels like you're just trying to force a trade because things have been going well, not because you're seeing something that actually is giving you an opportunity. Microsoft. Microsoft kind of gave like a one-day consolidation, possibly. I don't know. Micron sideways. Netflix just keeps on going. It's so strong. NVIDIA maybe starting to pull back. PLTR maybe. The dollar. Wow, that's really open. I mean, look at the dollar just drop. Boom, 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 boom. That's opening the door. When this happened last time, we had a great run. Let me show you. You can see it was dropping, then it just kind of gapped down here and stayed down. Might pull the dollar. I don't like that gap that much. I might pull the dollar index. Here's the VIX. Here's the VIX. You can see that it looks like it's ready to start pushing up. Wherever it gets to and rolls over, that's going to give us good information. Walmart, back up in the top of its trend. Materials ready to pull back. Communication services pausing. Energy, big drop today on energy. Financials starting to pull back. Same with industrials. Staples. Staples actually looks a little stronger than I would have thought. Utilities, not as much. Healthcare. Yeah, I mean, God, it's broad-based, right? There's no argument that this rally is broad-based. We see it across the board. It's just a matter of maintaining discipline, not forcing trades because we're suffering bouts of FOMO. And even though I'm looking for a little bit of a pullback, if it doesn't, I'm looking at Meta for a possible trade. We'll see what tomorrow brings. Let's go take a quick peek at the futures before we call it a night. Here's the ES. This is kind of flat. Just kind of flat. All right. Well, whew, that was a grinder, man. We got a lot of work done. I hope that was helpful. Hopefully, we're going to have more trading in our working sessions going forward. But we're willing to maintain discipline and not force trades. That's how we do it. Tomorrow, back on in the morning at 9:15 a.m. Eastern for our midweek check-in. We're getting closer to this announcement from the summit from Jackson Hole and Jerome Powell. So we'll see what happens there. Have a great rest of your night. I will see you guys in the morning. And as always, happy trading.